Good morning, good afternoon, and good evening, everybody. I know that there are people we have had many registrations. Some are even in Australia. For them, it's very, very late. Some are in the States. For them, it's rather early. So I'll try to make everybody's participation as worthwhile as possible. We're going to talk about assigning probabilities to climate scenarios. And when I say we, I'm referring to myself. My name is Riccardo Rebonato. I am the scientific director of the EDHEC-Risk Climate Institute, and Dherminder Kainth, who is the research director. We are working together on the same projects. The presentation, I will start very briefly, giving an idea of what we're going to cover. Then I'll pass on to Dherminder, and then it will come back to me. We will welcome your questions. During the presentation, please be so kind as to write your questions using the Q&A function at the bottom of the screen. And the questions will be collected, and then we will answer at the end. It will be 45 minutes of presentation and 15 minutes for the questions. If there are, as it often happens, more questions than we can answer in 15 minutes, we'll do our best to reply quickly and thoroughly to the questions in writing in the following days. So, structure of the presentation. So what are we going to talk about? We're going to talk about climate scenario analysis. And, well, it is important. I don't think I have to spend a lot of time about this, because if you didn't think it was important, you wouldn't be attending this webinar. But the important thing, it is different from financial stress testing. Why is it different? First of all, with financial stress testing, we are familiar with the stress scenarios that we are working with. If we say a scenario could be interest rates moving by 200 basis points, if we say a scenario could be an equity index fall by 20%, we know in the back of our minds roughly the probability of these events. We have an intuitive feeling, and we don't have to rely on an intuitive feeling, because if we want, we can do a formal statistical analysis and say, okay, such and such a move has this kind of probability. However, when it comes to climate scenarios, we really do not have a meaningful experience of the damages that can be incurred for different levels of what are called temperature anomalies. Temperature anomalies are difference in temperature between a given point in time and pre-industrial times. We have luckily observed so far relatively small temperature increases of the order of 1.2, 1.3 centigrades, but we fear that depending on the abatement policy, these temperature anomalies in decades to come might be much higher. And at this point, we cannot rely on our market experience, to assess what kind of severity we can associate with these scenarios. So this also answers a question that many people ask me. And they say, I've been using scenarios for all my professional life, and I can use them pretty well without any probabilities attached to them. To these people, my answer is, yes, you can do that, because your market experience, your background knowledge allows you to associate a probability in the back of your mind. So you have this ability to say, should I really worry or not? But if I told you, okay, we're going to look at a scenario of an 8 watts per meter square forcing, many people don't even know what that means. And even if we knew what that means, or even if it were translated in more familiar quantities, we do not have the ability to say automatically, instinctively, I don't know, instinctively is not the right word, but you know what I mean. Oh, okay, so this is a very far out scenario, this is a real, very likely scenario, etc. So we have to do something to associate probabilities to scenario outcomes. Otherwise, at the most fundamental levels, an investor doesn't know, should I really worry about this or not? Is this something that warrants my attention or not? The next thing is a distinction between what I call conditional and unconditional scenarios and probabilities. What do I mean by that? A conditional scenario says, if you tell me what the emission path is going to be between now at a certain point in time, then I will tell you the outcomes. So these outcomes are conditional on the emission profile. The unconditional one says, actually, there is a distribution of these emission profiles, and therefore I'm going to give you the overall probability. Clearly, this is much more difficult because it entails expressing probabilities about policies. And this is difficult, but as we shall discuss, it is not impossible. Important caveat. We are trying to associate probabilities to scenarios. These probabilities will never be sharp probabilities with 3 decimal points. What I want to do is to provide an order of magnitude estimate of a probability. Is this a 1 in 10, a 1 in 100, and 1 in 1,000 probability? So this is the type of goal that we have in mind. And we are very well aware that there has been a lot of work, and there's been a lot of high quality work in scenario analysis. My colleague will talk about the SSP-RCP framework, and the reason why we're spending some time on that is because it is a benchmark, and lots of people understand it, know it, and use it. And it has been created by excellent academics, and it is of very high quality. However, it has not been created with the needs of investors in mind. It was created for policymakers. And for reasons that we will explain, well, one important reason, there are, by construction, no probabilities attached to the different scenarios. So we are taking 2 strands. In one strand, we are trying to stay as close as possible to the SSP-RCP framework because we acknowledge it was a good starting point, it was a breakthrough at the time, and lots of people use it. But then we say, actually, we can do something which is arguably more useful for investors by departing in some ways from the SSP-RCP framework. So this is our plan, and I'm going to pass the word to my colleague and friend Dherminder, who will tell you how the SSP scenario works, what are its strengths, what are the limitations, and what we can do better. Dherminder, floor is yours.
Thanks very much, Riccardo. Good afternoon, morning, and evening to everyone. Riccardo, if you could go to the next slide, please.
Yep.
Yeah. So just to carry on with the theme, so basically we all understand that climate risk is a multifaceted, complex risk, and the extent to which it materializes depends on kind of 3 main factors: sort of global future socioeconomic development, how wealthy do we become in the future as a globe, and therefore what are our energy requirements, and then how much of that do we get from fossil fuels. Second thing, which is the climate change physics. So basically, how does the Earth respond to those increased greenhouse gases? How much hotter does it get? And then finally, how successful are we going to be in abating or removing this the greenhouse gases? So our final temperature at some given horizon is going to depend on kind of those 3 things. Now, this is obviously a problem which has been core to what the IPCC has done over the last 30 years or so. And what they use is scenario analysis. Fundamentally, all of those strands that I've discussed are carried out by a number of very specialized academic research groups. And what the IPCC are tasked with doing is try to bring that research together and provide plausible futures which policymakers can then act on. So how do they do that? Well, they use scenario analysis to bring those disparate strands of research together to provide something which people can then understand and act upon. Now, the scenarios are deliberately designed to have no associated likelihood. Now, there's a reason for that, a very good reason for that. The view is we want policymakers to consider a wide range of possible futures, so that there's not this view that there's a central scenario, this is what's going to happen, we risk manage to that, and then basically the future, which is a long way coming, comes out different, and we're then unprepared for that. So there's very definitely a view to try and create a range of possible futures that policymakers can then act on. So how are, the way in which the scenarios are generated is kind of interesting. And what they've tried to do is capture this idea of to have different research groups produce independent strands of research. So basically to create pathways or potential future pathways for the socioeconomic future. So how well do we do economically? What's the population going to be, et cetera, to do that as one separate strand of work, to then separately to create what they expect greenhouse gas emissions to do. And the way that those are then integrated together is by figuring out or understanding how much money do we need to spend, given a particular socioeconomic pathway, how much money do we have to spend to make sure that the greenhouse gas emissions and therefore the temperature rise comes out as per a particular pathway. So basically, the two strands of carbon dioxide emission and socioeconomic future can be developed independently, and the integration is done through the scenario. Next slide, please, Riccardo. So let's just talk a little bit about what those different components are. I'm sure they're familiar to many people, but just as a very quick highlight. So the SSPs are these shared socioeconomic pathways. Actually, they're just 5 pathways. They're very different pathways, and they're deliberately, what's been done is to create these 5 pathways, and fundamentally, lots and lots of research looks at the impacts of climate change, on adaptation, on our energy needs, on human health, et cetera. Now, if all of that work was done independently, you wouldn't be able to tell whether it's due to different assumptions about population growth, or whether it's really due to a particular climate change, a particular effect. So what's been done is to create this conditioning, and this conditioning is done through these 5 socioeconomic pathways. So what's projected is kind of a range of factors. So population, development indicators, health, education, economic growth, social changes, et cetera. All of these things, many of these things are just given as broad brush narratives. But there's a small subset, which are given as numbers, country by country, out to 2100. And those numbers which are given are population, GDP, urbanization, educational attainment. And as I say, these are widely accepted, across thousands of academic studies. Next slide.
Sorry, yeah.
Yep. So I'm not going to talk to this slide. I mean, there's a huge amount of detail here, but it's just to give the readers, the viewers, kind of a bit more detail on what these different scenarios do. As I say, there are 5 scenarios. 1 and 5 kind of see a positive economic growth, better than it is today. 5 is kind of fossil fuel led. 1 is kind of green economy. We transition to a green economy very, very rapidly. 2, SSP2 is kind of like what the world is currently. Sorry, Riccardo, the slide deck has disappeared.
Sorry, apologize. Are you finding?
Yeah, I can't see the original slide.
Sorry, coming back. Are you seeing the slides now?
Yes.
Just a second. It's been a...
Yeah, just...
Yeah, here we are.
Yeah.
Sorry.
Yeah. So slides 3 and 4, SSPs 3 and 4 are kind of do more rivalry and inequality. So that's kind of a basic overview. There's more detail on the slide. Next slide, please, Riccardo. Okay, so that's the socioeconomic future. The other thing that we kind of get projections for is how much greenhouse gases are going to be emitted into the atmosphere. And the way the IPCC do that is kind of through so-called representative carbon pathways, RCPs. And all those are really is a path of future greenhouse gases into the atmosphere over the next 50, 80, 100 years, up until 2100. Now, the more greenhouse gases which go into the atmosphere, the greater the amount of energy, the net energy which is absorbed by the Earth. And so the way that these the amount of greenhouse gases is going into the atmosphere is characterized is basically energy imbalance, and that's what these RCPs do. The more greenhouse gases we put into the atmosphere, the more the net energy going into the earth, so the number becomes higher. And this so this is what these RCPs are. There are 4 originally developed. There are now many more, but basically there's RCP 2.6. 4.5, 6.0, 8.5. And basically what that means is that there's more heat going into the earth as you go to higher numbers. What that means, of course, is that the temperature by 2100 would be higher, all else being equal with these 4 pathways. Now, these RCPs are they cover a very diverse range. And that's deliberate because these were used by climate models who want to test their models. So RCP of 8.5 requires a lot of burning of a lot of fossil fuels to achieve, or not achieve as it may be. Okay, so these scenarios are, again, quite extreme. So how do we bring these together? And the way that these are brought together is using the scenario methodology, sort of process-based IAMs. So what the IPCC are trying to do, of course, is to project the cost-effective mitigation pathway to achieve a given policy outcome. So we want to limit warming to 2 Celsius, or we want to limit warming to 3 Celsius. How are we going to do that? Well, given a trajectory for population and economic growth, what we have to do is the principal lever that we can pull is how much money do we spend on abatement. Okay, so how do we model that? Well, what's done is to use the so-called process-based integrated assessment models. Now, these are very granular constructs that explicitly model the evolution of the global energy demand and the global energy supply, as well as things like land use, et cetera, over the next 100 years. And they do that as a function of the underlying socioeconomics. So, how many people there are, what the GDP output is, et cetera. And they incorporate things like investment feedback. So as we use more green technology, we get better at it, and that's therefore becomes cheaper. And also discounting. Sorry, next slide, Riccardo. And so what these IAMs do is they do an optimization. So they are given, they know that we want to hit a particular temperature by 2100. They know what trajectory we're going on in terms of population, and they know the big handle they've got is they've got how much money we're going to spend on abatement. And what they try to do is they find a way to make sure energy supply hits energy demand, and we hit the constraints, i.e. we get to the temperature, the specified policy objective, and with the market clears. And we develop the lowest cost of supply. And that's how the scenarios are then created. So you can see pretty much quite easily, you can kind of create a scenario matrix. And the scenario matrix has kind of got columns on the top, SSP 1, 2, 3, 4, and 5, and basically a forcing level. You can kind of think of this as a temperature. So low temperatures at the bottom, high temperatures at the top. So if you want to do low temperatures, you want to achieve low temperatures, you're going to have to spend a lot of money in mitigating. You're going to have to spend a lot of money on mitigation. So that's why the costs are high. Correspondingly, if you've got low temperatures, you're probably not going to have to spend so much on adaptation, which is why on the bottom row we've got temperature. On the bottom row in the second graph, we don't have to spend so much on adaptation or residual impacts. Obviously, as temperatures go higher, as we go, if we're not fussed about global temperatures, well, actually, we don't have to spend very much on mitigation, but the impacts on the second chart are much, much higher. Now, one important point to make is that some of these combinations are just not achievable. So within SSP, so actually it turns out that a forcing of 8.5, i.e. very, very high forcing, very, very high temperatures, which is part of the scenario framework, is not achievable in SSPs 1, 2, 3, and 4, which is kind of interesting. So next slide, please, Riccardo. So just some observations on how the framework works. So the frameworks, you know, it's quite neat. It creates a matrix, and as you say, we can analyze all those scenarios in the matrix, and it covers a very wide, diverse range of possible futures. Some observations. So fundamentally, feedback effects are not included. So the feedback effects are deliberately excluded. So, for instance, to the extent that climate damages affects future growth, that's not captured within the situation, within the approach. Also, what's interesting is that because the horizon only goes out to 2100, the principal risk that which we're worried about is transition risk. Physical risk from damages will actually be towards the end of the century or later on, and that's not actually part of the scenario framework. Also, again, this feedback effect, we don't, you know, agents don't react to higher taxes or higher temperatures or higher damages by, you know, they're just trying to optimize to this policy goal. There's no feedback effects within the model. Okay, what I guess, you know, having discussed that, I guess what we would argue is that it is probably quite complementary and quite useful to have probabilistic methods to sit side by side with this scenario framework. So the guiding principle of the framework is that there's no each box, each combination should be treated equally. But we already know that that's not the case. People implicitly have an understanding of which RCP, SCP, SSP combinations they believe to be more likely. So, for instance, SSP2 4.5 is a base case favored by the NG of Hurst. So already people are implicitly doing picking out what they think is more likely and scenarios which is not. So there's a subjective association of probabilities. What we're going to argue is that using probabilistic methods, building benchmark tools, is quite a critical complementary tool for challenging scenario plausibility. And also, when we can develop sensitivities, we can make risk-based decisions, which is kind of important, very important for a financial context. Next slide, Riccardo.
You're aware of the time, Dherminder?
Yeah, so I'm just going to very quickly skim over this. I've got 2 minutes. Is that okay?
Yeah.
Okay, so I just want to give, in the next 2 or 3 slides, I'm going to just give a very quick introduction to some of the things which, when you look inside the SFP scenarios, which suggest that there's, you know, that we may, you know, why our approach works. So this first slide kind of just shows in microcosm what we're proposing. So if and it's a very simple thing, which is basically the population projections within the SSPs. So the population projections within the SSPs are kind of shown in the graphs, and they're the blue curve, the orange curve, the colored curves. So these are kind of expert judgment led, and these are the population projections which have been created. Now, you could immediately start, if you looked at those pictures, people will start to think what they believe to be a mean. They will start to think what's a likely scenario, and they might sort of think, well, you know, it looks around the 4 scenarios at the bottom, and kind of SSP3 is something of an outlier. However, you know, the UN and lots of other people are now developing truly probabilistic models which capture sort of the fertility transition, et cetera, and these models have been are now used by, for instance, the UN or other bodies to determine what they think the best estimates of population projection are. And this is shown in the grey. So what I've shown is the 5th and 95th, 20th and 80th, and the mean. And you can kind of see that there is, while the SSP projections are much more disparate, what one might consider to be the mean and what one might consider to be a reasonable range of variation is very different from what one might infer from the SSPs. So that's kind of in microcosm what we're trying to explore in what we're doing. Next slide, Riccardo. The other thing that we find in terms of when we look at the SSPs and the GDP projections within the SSPs, well, one of the big things about using these projections is fundamentally there's just a single path, right? So each SSP kind of creates a single path. Now, the SSPs have been used to project growth, and they've been carefully designed, right? So the SSP2 kind of mirrors, it talks about a growth rate of 2% per annum over the next 50 years, falling away to 1.6% over the period of 2100. Now, that's very much like what's happened in history between 1970 and 2020. And the other scenarios kind of span either side of that, or rather 3 is below, 1, 4 and 5 go significantly above that. So they give this view of what our economic growth is going to look like, and they kind of give this view. Sorry, next slide, Riccardo. However, when you look inside the scenarios, what you find, of course, is that because they are single scenarios, what they tend to do is they give smoothed mean reverting behavior. So what I've done in the graphs is shown a comparison between developed countries, BRICS countries, and emerging market countries about what the annual GDP growth does. The top line is kind of historically what's happened, and the blue line and the lower plates are kind of what's the projections are. And you can kind of see that in the projections, there is a very smooth mean reverting type behavior, as you might expect. Whereas the behavior inside, or what's actually happened, is that development GDP growth is much more volatile. Now, it's very difficult to include volatility in single scenarios. You can do it if you do sort of probabilistic projections, but you can't do it in sort of single scenarios. Now, that's obviously quite important. I mean, that's fine if you're doing long-range projections and you're looking at the globe, but it is an issue when you're starting to look at looking at financial asset pricing, because the volatility of growth will lead to precautionary savings and different investment behavior. It leads to credit cycle type issues. Trade flows will be qualitatively different. So these scenarios are not so easy to use in a financial context. Last slide, Riccardo, please. And the one other thing that we look at is within these scenarios is we look at the carbon tax, which is kind of the carbon tax which is levied upon emissions to remove CO2 to hit a particular target. So what I've done is plotted out the fraction of the GDP which is going to be spent on abatement over the next 100 years in SSP2, which is this BAU case. And kind of what we see, even in the moderate SSP2 scenario, it sort of shows a tax rate of 8.5% being spent by 2100, but much more importantly, that this tax rate, the initial tax rate requirement is small, but grows very, very rapidly. Now, this is kind of as a result of how the assumptions about discount rates are deeply embedded inside these within these scenarios. But obviously, one might challenge that, and obviously the choice of a 5% discount rate may not be the most appropriate for valuation of assets. Riccardo, I'll hand back to Riccardo.
Okay, thank you, Dherminder. So, big summary. What are the problems, the big problems that we have identified? Problem number 1, to each narrative, there is only one outcome. So there is no dispersion. Number 2, we have no probabilities attached to scenarios. So that is what we're going to try to remedy, to add a dispersion of outcomes associated with each narrative and some probabilities to the forcing concentration and temperatures. So this is what we want to do. And as I said at the beginning, we're going to stay close to the SSP RCP framework. And now we have to do the baseline case and the policy case. Whenever we have a scenario, we always have a scenario with reference to some baseline. The baseline in the case of the SSP or RCP is same abatement action as what has been done so far, which is very little. And then you consider the differences in outcomes with respect to other policies. So the first thing is the baseline case. In the baseline case, what are, at the end of the day, the fundamental quantities that will determine emissions at the chosen horizon. How many, it will depend on how many people there are there, more people, more emissions. It will depend on the technological development. It will depend on the GDP, or rather GDP per capita. So these different quantities are all put together in what is called the Chi identity, which is this equation here that says the emissions are equal to the population, GDP per populations, and emission per GDP. In the baseline case, I don't have to make any assumptions about the abatement policy. So we seem to have these three different levers: the population, the GDP per person, and emission GDP. And if I just very simply said everything can be in a low, medium, and high state, 3 to the third, it gives me 27 scenarios. It looks very complicated, but that is not the case, because there is a fundamental variable, which is GDP per person, that explains lots of things. For instance, population growth decreases when GDP per person increases. The carbon intensity of the economy decreases when the country becomes richer, because the country moves towards services from manufacturing. So within the model, within the SSP-RCP model, you see here, there are some very strong relationship between population growth and GDP per person, or emission per GDP on growth of population, or again, emission and GDP on GDP per person. So these are all relationships which are embedded in the SSP-RCP scenario. And this has given us something very powerful, because they say, if we can just model the GDP per person, from which we have a lot of economic information, we can derive all the other quantities that we need to build our scenarios, the technology, the population, and the emissions, thanks to the relationship which have been embedded in the model. So this is the fundamental idea. I won't go into the details, but this brings us to the next step. Baseline case is done. I just express everything as a function of GDP per person, and I create a distribution for the GDP per person. But now I'm meeting the difficult problem, which is, what do I say about emissions? What is the probability of emissions? The fact is that the probability of emissions is linked to how much tax, how much abasement do you do on the way to your horizon. And again, within the model, we have worked out this very nice relationship between the cumulative carbon tax which is paid, it's in trillions of dollars on the x-axis, and the reduction in emissions. So if you tell me how much tax you have paid, I can tell you what the corresponding reduction in emission would be. Now, again, I'm going to stay at very high level. You can say, okay, how do I know what is a reasonable level of tax? Again, my GDP per person is a very powerful explanatory variable. I have here a graph that shows me tax revenues a percent of GDP, and on the x-axis, I have the log of GDP per capita. You see how there is a very clear increasing relationship, and even more interesting, here is the next one. This is log of GDP per capita, and on the y-axis, how much countries spend on the biggest spend tickets of all, which is healthcare. And by the way, this points at the top here is USA, but is the USA. But you see that there is a very clear increasing relationship with log of GDP per capita. And probably, I would say, this gives me some bounds for how quickly it is reasonable to expect that we can raise taxes for carbon abatement. So I am saying I am creating some bounds, and the bounds can be fiscal of this type, or it can be technological, because if I try to put too much money into abatement, I have to build so many wind turbines, I have to install so many solar panels that hit against technological constraints. So this, I think, is a very nice rule of thumb. Take the world GDP today, 100 trillion. Take the current emissions today, approximately 40 gigatons. tell me a carbon tax of X dollars per ton. I can immediately work out what percentage of GDP that implies in terms of tax. For instance, a $100 per ton corresponds to a tax of approximately 4% of GDP. And now I can compare, the world spends 3% on education, 3% on defense, 8% on health. So immediately tells me how likely some of the carbon taxes are, the social cost of carbons, it gives me a yardstick. And this is very useful because when we build a general scenario framework, we have to ask ourselves, okay, what is this distribution of emissions? And we start from, this is a study which has been done by Toll that has asked a lot of economists, what do you think the correct social cost of carbon is? Now, some of the responses were rather extraordinary, thousands or tens of thousands of dollars per ton, which are not at all realistic. And again, you know that they're not realistic because when you translate them into an equivalent tax, you get astronomical numbers. So we adjust this distribution that you see here. These are the distribution of responses, taking into account feasibility constraints. And when we do this, we estimate bounds for the distribution of the social cost of carbon. Now we can take two approaches. Either I say, look, I really am totally agnostic. I just say that anything within this bound is equally likely. Or I say, okay, I'm going to take the distribution of social cost of carbon. I'm going to translate that into a distribution of equivalent abatement. And I have something which is, it has more structure than a uniform distribution. Now, I won't go into the details of the exact link because I'm really keen to get to our bottom line. So what have we done here? We have created, using this information, in this case 10, it could be 20, it could be 5, anything you want, equiprobable abatement schedules. So when you're at 100%, you're fully abated. We start from 5%, and this is how the different abatements go over time. You might say, oh, but these are very smooth abatements. Don't worry, because each of these is a representative of an infinity of more complex abatement that give the same concentration. So here I have 10 equiprobable abatement schedules. To each abatement schedule, I have a distribution of temperatures at the end that give rise, and this is the most important slide of the presentation where I would like to pause and stop for a moment. So what do we have here? What have we obtained here? I wouldn't agonize about the exact numbers, but this is the bottom line of this part of our research. So this gives me a distribution for temperature anomalies. So in this case, the distribution is based on the pessimistic side. Again, I won't discuss here whether it should be half a degree more to the left or to the right, but it tells me something very, very interesting. For instance, some people have said some of the scenarios that Dherminder was talking about, the SSP RCP with the RCP of 8.5, says, oh, that's impossible. It will never happen. Well, that is a scenario that corresponds to this part of the distribution. And I say, well, it is a very high temperature scenario. It has low probability, indeed. It is not impossible. So this allows me to associate probabilities to each individual temperature bucket. Furthermore, for each temperature bucket, I can associate what are the physical damages that correspond to that temperature bucket? What are the transition costs that correspond to that temperature bucket? And transition costs, at the end of the day, are some form of taxation that someone has to pay. It might not be the neat carbon tax, but it could be a form of taxation, that direct or indirect taxation that either a consumer or a corporate will have to pay. And this therefore feeds directly onto equity valuation. So this to me is a key instrument in order to translate the information that we have about the system into information about the temperature, about the physical damages, and about the transition costs. Remember that physical damages and transition costs are, if you want, two sides of the same coin. The more you spend on transition, the less you will incur in physical damages. It is therefore important to have the two things together. Now, in a few minutes I would like to show you something which I think is very interesting. I showed you before, or we showed you before, the relationship of various quantities as a function of GDP per person as it comes out of the SSP-RCP models. However, we can look at these things in reality, and this is what we do here. And I find these graphs, these graphs, by the way, are at the bottom of how we obtain the distributions here. So what do I have here? The top row is the USA. The bottom row is the UK. And from the left to right, I have emissions per unit of energy, energy per unit of GDP, and emissions per GDP. Look at the very nice and clear graph. And on the x-axis, I have GDP per person. As countries become richer, emissions, energy, and emissions per GDP decrease. And this is found virtually universally on developed countries. Look how developing countries is quite different. Look, for instance, I have China and India. Look at this humped structure in energy per GDP. The humped structure means when the country is on the x-axis, I don't have time. I have GDP per person. When the country is still very poor, it develops by using a lot of energy intensive and emission intensive technology. They have to build stuff, they have to do buildings, they have to build infrastructure, which is very energy demanding. As they become richer, they follow the same type of decline that is shown for the more developed countries. And it's interesting to see that you see a very similar pattern in countries such as diverse as China and India. So this is very powerful and very useful, and these are the tools that we are using to obtain these distributions here. Summary. We have explained why the SSP-RCP scenarios must be handled with care and why they are not really suited for the needs of investors. And we have presented two different ways to generate conditional or unconditional scenarios with probabilities attached to them. Remember the distribution there. We've got the probability. With probability-aware scenarios, investors can focus on those scenarios that are more likely to occur, have an appreciation of the degree of uncertainty associated with each scenario, and explore, if possible, tail events and what must happen for this to materialize. We are focused on physical damages, but the approach that we use can give us a handle of a scenario-consistent transition risk. People talk about transition risk as living separately from physical risk. In reality, the two things are, as I said, two sides of the same coin. And why they are is very intuitive, because the more I spend, the greater the effort on abatement, the more I reduce the physical risk, and vice versa. And therefore, from the point of view, think of someone who's using a discounted cash flow valuation. What I want to know is all impairments that occur to cash flows. I don't care if they come from physical or for transition. I have to look at the two in conjunction. And again, this distribution here is the handle that allows me to carry out this type of analysis. Okay, for time, I think I will stop here, and I think there will probably be questions, and I'm sure that Dherminder has collected the questions, and we'll do our best to answer them.
Okay. Thanks very much, Riccardo. So I've got a number of questions sent through. Perhaps the first one, I think, which resonates most, is a question from, I think, the Far East, and it's basically this. So what are the practical implications of the work that you've discussed?
Yes, very good, very good. Well, again, we are looking at all of this from a perspective of the impact of climate change on asset prices. So there are many ways of arriving at this type of assessment. Ultimately, so one typical model is discounted cash flow model. This is what equity analysts have been doing for decades. They project cash flows at different points in time and they discount them. And then we can talk to the cows come home about the discount rate, but let's leave that for one side. Now, the impact comes from of climate change, comes from seeing how are these cash flows impacted by climate change. And by the way, I might have a green and a brown company that responds in different ways. That's what is giving us here is, let's go back to this picture here. It says, I can give you to each of these bars here, to each of these temperatures here, there is associated a physical damage, and there is associated a distribution of transition costs. And therefore, I can assign a probability to each cash flow impairment. And therefore, if that is the route that I follow, and it's not the only route, but at the bottom of it, at the end of the day, they're all quite similar, I can weigh the different cash flow impairments by probabilities that are given by this distribution here. So at the end of the day, if we are interested from an investor's perspective, clearly there are regulators of other perspectives. I'm thinking from an investor's perspective, how do I assess the impact on valuation today? One aspect is the discount factor, and we might talk about in the next webinar. One aspect has to do what happens to my cash flows. And this is the handle to give me a quantitative estimate of the impacts on the cash flows.
Yeah, thank you. I mean, I guess there's a number of people who sort of, perhaps following on from that that same question in terms of looking at the applications and are kind of interested in perhaps what you allude to, which is looking in more detail at the implications on asset prices. So, and I know this is work that we're, I guess, engaging in, whereby a number of the participants are interested in understanding how what would the effect of climate change be on a sample of assets, how the mechanism would impact on investors.
Yeah,
so I think that's certainly some of the.
Please allow me to add something here.
Yeah,
there are two strands. One is the top-down approach, and one is the bottom-up. We are definitely taking a top-down approach. I think that it's not that one approach is good and one approach is bad. The two approaches have to meet in the middle, and the two approaches give pieces of information that the other approach misses. So what is the global information that the top-down approach gives, for instance, about transition risk? Transition risk, we are not going to come from the top-down to the specific impact on the specific company. However, if we look in the aggregate, if I think of the impact of, let's say, a global equity index, a diversified equity index, as I was saying, all these abatement costs, at the end of the day, are taxes mainly paid by the corporates. There has been a recent paper by the Washington Fed that has linked the equity performance of the last 30 years to two main drivers. Interest rates, the fall in interest rates via the discounting factor, and the decline in corporate tax. So this means that to the extent at the global level that I have a greater abatement cost, it is equivalent to a greater corporate tax, which is therefore a hit on equity performance. And the degree of hit depends on the abatement effort. So I might have a very small abatement effort, so the corporate tax is more, but for a small abatement effort, I have a big damage. And so that is why I keep on saying the two things are in tandem, And this trade-off in the aggregate, not at the single company level, can be only appreciated with a top-down approach. So the two things have to come together. Then there are differentiation amongst sectors, which are very important. It's a bit like saying, it's important to say how the cake is split, but it's also very important to know how big the cake is. The bottom up tells you how the cake is split, and the top down tells you the size of the cake.
Yep, thank you. I guess following on from that, one of the questions that looks of interest is, how do you have a view for how climate change will affect interest rates?
For what, sorry, for?
Any thoughts on the impact of climate change on interest rates?
Yes, that's a very, very interesting. And when you say interest rates, as I was saying before, one shouldn't just think on the impact of interest rate on fixed income securities, which is the obvious. Within fixed income securities, it is almost a tautology. But the level of interest rate via the discounting channel has a big, big impact on equity valuation. We have just, think of what has happened as we exited the Lehman period, 2008, 2009. Equities from 2009 have rallied. And this has been associated with a massive decrease in interest rates. And at the beginning of the 2009, 2010, as equities were rallying, is not because people were feeling so bullish about cash flow prospects, but it is because the discounting was depressed so much. So interest rate is key, not just to fixed income, but also to equity valuation. And then your question was, how does climate change affect interest rates? Here it is a tricky question. First of all, if the climate damages are such that they create a depressed economic activity, so in situations of severe climate damages, or climate damages so severe that the economic activity is depressed, typically what the central banks have been doing so far has been to cut rates, so to put a safety net underneath. However, there can be situations where this rescue behavior by the central banks becomes inhibited. And what could this be? One situation is inflation. But the second situation to keep in mind is the level of public debt. Now, there has been a study by the IMF, and they have said, if we pursue abatement policy, which would take us to the Paris Agreement 1.52, so a very ambitious target. What is the increase in, and if we assume that the split between tax and public debt is roughly the same, so how do we finance the transition? Either with taxes or with public debt. So if we assume the same mix that we have observed so far, that could mean an increase global, at a global level, of public debt by the order of 40%. Now, this really now depends, that becomes very country specific. In some countries, there is fiscal room for an increase of 40% in debt to happen without investors panicking and without interest rates becoming very high. But there are other countries in which this room for maneuver is not possible. And for those who have followed the events in 2022, with the shortest UK government in history that lasted for 6 weeks, a budget was proposed which was unfunded, and the interest rate markets panicked, and interest rates moved dramatically in an extremely short time, simply because all of a sudden something was perceived to have broken, and the non-sustainability of the debt immediately created a big shock in interest rates. So, answer to the question. Normally, if the economic activity is depressed, we can hope, count is too strong, but we can expect accommodative monetary action by central banks that could put a safety net under the equity valuations via discount, by lowering rates. However, we shouldn't count on this, especially because there can be scenarios where we have large increase in public debt that might inhibit the ability of central banks to cut rates and to provide this safety net. And plus there is inflation. Inflation is such a complicated process, and it's just a complicated phenomenon, which is extremely difficult to predict under what conditions it might arise. And therefore, that is just like something always to keep in mind. Clearly, if there is high inflation, there is no way the central banks can cut rates and put what I call the safety net. It's a Greenspan put. That has been the principle of the Greenspan put since the 1990s. And the Greenspan put idea was when either the economic activity weakens strongly or in the financial markets weaken so strongly and dramatically that they could have repercussions on the real economy, we're going to cut rates. And that has remained in place until the latest inflationary bout of 2022. Do we have time for another one? Yes.
We do, yeah. I mean, so there's a couple of interesting ones. So maybe just very quickly. One of the questions we're getting is, do you have any comments or thoughts on our work in relation to things like the NGFS scenarios and central bank stress testing work, which is ongoing?
The NGFS scenario, well, again, as you all know, the NGFS scenario is taking one of the narratives, which is the SSP2, which is called middle of the road.
Business as usual. Business as
usual, middle of the road, yes. And this is, in a way, reasonable, because it's called middle of the road, so it has a flavor of being probably the most likely. As Dherminder clearly pointed out, in reality, there are no probabilities attached to these scenarios, but let's take it as a starting point. And then instead of using RCPs, the NGFS has used five or six different decarbonization temperature targets, and which is all reasonable. However, in the NGFS, we have physical damages alongside transition damages, but it still inherits some of the problems. First of all, probabilities are not well defined, and it only takes one of the five scenarios as a starting point. So this already curtailed enormously the range of possible outcomes. So even if you put a spread by the five temperature outcomes at the end, you have no spread, no uncertainty associated with the technology, the population, the economy, etc., etc.
Yeah, which obviously then will impact
absolutely.
Financial asset valuation.
Yeah,
absolutely. So I guess perhaps one last question, maybe. We've got time. And this is perhaps an open-ended question, and maybe again refers back to what you were saying earlier in terms of future webinars, and maybe it's just an attempt to publicize future work. But one of the a number of the participants have asked a question about once we've got this temperature distribution, how do you convert that information into impact on asset class returns and obviously
very good question. Very good question.
Sectoral returns.
Yeah.
So how do we do that translation?
Absolutely.
From
there is an excellent question. Now, formally, the link is via what is called the damage function, but this is just giving a name to something that is extremely difficult. The damage function tries to map a temperature increase. It takes a temperature as a proxy for climate. There are many more things to climate than the temperature, but takes that variable as a proxy for climate and associates an economic damage. Now, there is huge disagreement amongst academics, among economists, amongst practitioners, etc., as to the correct damage function. The famous DICE model has been criticized for using an unduly tame damage function. One of the key points is, are we close or not to a tipping point? And here, the physics doesn't really give us an answer, because the knowledge of where the tipping points are located and what is the impact is really not known. the most reasonable thing to do, again, is to use, as we do in our analysis, this distribution that I showed. Actually, I think the distribution is still on the screen if you look at it, has been obtained by using a spread of possible damage functions. The damage function at the end of the day boils down to what's called the damage exponent. And we use a distribution of damage exponents that encompasses even the highest values that have been proposed in the literature. So it is fundamentally important to keep uncertainty in the damage function into account. So that is one of the biggest sources of uncertainty.
Riccardo, I don't think you have that figure up, but nevertheless, yes. The point is you include
the... It was the figure that I showed before, yes.
Yeah.
But I thought it was still on the screen.
Yeah.
Okay.
So I think that's time. That's 2 o'clock. So I was going to thank all of the participants. We have received many questions. I think there's over 50 questions.
Oh my goodness! I know what I'm doing during the weekend. Yes,
which we haven't.
Yes.
We've only been able to touch the surface of those. So obviously, we will write back. We will write back to all the participants with answers over the course of the next few days. But on my account, I'd like to thank everyone for attending and for making this a very valuable session. Riccardo, just handing to you.
Thank you. Same for me. Thank you very much. And I'm looking forward to reading all the questions, and we'll do our best to give intelligible answers. Thank you very much.